You spend weeks perfecting a strategy on a demo account. The entries are sharp, the profits are consistent. But the moment you switch to real capital, the entire system shatters. This happens because of a habit called visual scanning. You scroll back through historical charts, spot a few clear winning setups, and convince yourself you found a reliable pattern. Your brain is wired for confirmation bias. It immediately locks on to that massive 100-pip profit run, which effectively blinds you to the brutal 40-pip drawdown that happened just hours before. Strategies born from this bias inevitably collapse when the emotional pressure of real capital exposes the lack of a real dataset. Transforming these subjective ideas into a battle-tested roadmap requires a rigorous framework, a process known as scientific manual backtesting. True market edge is engineered by subjecting your ideas to a systematic stress test. The first phase of this stress test is the logic chamber. Vague concepts like strong momentum or a good feeling are impossible to measure and must be eliminated from your plan. You must translate your intuition into rigid binary rules using an if-then framework. For example, if price hits a supply zone and we see a 15-minute change of character, then we enter at the retracement. A setup is either 100% valid or it doesn't exist. The second phase is the blindness chamber. Even with rigid rules, knowing the future price action of a chart makes any historical review invalid. You maintain integrity by using a double-blind protocol with tools like TradingView's bar replay. You pick a random historical date and completely hide the right side of the screen. Now comes the actual work. You click forward, candle by candle, honestly logging every entry. This includes the scary-looking wicks, the sudden fakeouts, and the sideways border, where the temptation to overtrade is highest. A strategy only proves its worth if you can consistently execute that edge without knowing the outcome of the very next candle. The third phase is the friction chamber. Historical charts are a sterile vacuum, but the live market is a costly environment that demands a profit margin. Tight spreads and execution slippage are invisible costs that frequently turn a winning paper strategy into a losing live account. You account for this reality by applying a spread tax. Using institutional simulators like Soft4FX, you manually add a 1.5 pip penalty to every single trade you log. The final phase is the endurance chamber. A strategy that wins 20 trades in a row might just be enjoying a lucky streak within a specific market trend. To achieve statistical significance, follow the 200 trade rule across trending, ranging, and choppy market regimes. This 200 cycle test provides your true expectancy. Multiply your win rate by average win and subtract loss rate times average loss, revealing your mathematical value. A strategy that survives all 4 chambers has the statistical foundation of an institutional-grade edge. Backtesting serves to identify exactly where your logic fails before the live market charges you for the lesson. Amateurs trade on hope, which breeds anxiety. Professionals trade on statistical inevitability, allowing for calm execution even during inevitable losing streaks. Put your own system through the pipeline today. Download the FXNX scientific backtesting spreadsheet and commit to manually testing 100 trades of your current strategy. Take that data and feed it into the FXNX Risk Manager. This allows you to calculate objective position sizing based on your actual documented drawdown. Once a strategy passes the certification pipeline, you are ready to deploy that edge on an FXNX NX1 account with zero